I want to start with something I noticed while helping a family member go through their monthly bills last year. She is retired. She is careful with money. She checks her grocery receipts and clips coupons. And yet, when we sat down and looked at everything she was paying for each month, we found over $300 in services she was either barely using or completely overpaying for. Not one giant charge, just a stack of small ones, each one looking perfectly reasonable on its own. Together, they were quietly draining her fixed income every single month. That is what this video is about. Because here is the thing. Retirees are often targeted, not with scams, but with services that made sense at one point and now just keep renewing. Services that are priced a little higher than they need to be. Services with add-ons nobody asked for. And services that have cheaper alternatives most people never think to look for. We are going to go through 10 of them today. And one of these, I am going to hold it until number 7, is one that most people on fixed incomes assume is just a fixed cost, but it is not. And the overpayment can be hundreds of dollars a year. If you are finding this channel for the first time, this is Better Deal Daily. We talk about everyday money traps, hidden fees, and practical ways regular people can stop overpaying. Hit subscribe so you do not miss what is coming next. Now, let us get into the list. Item number 1. Landline phone service. This one feels like it should be ancient history, but it is not. Millions of retired Americans are still paying for a traditional landline, and the monthly bill has quietly crept up over the years. Depending on the carrier and the package, a basic home phone line can run anywhere from $30 to $60 a month. That is $360 to $720 a year for a phone that may ring a few times a week. The original reason for keeping a landline made a lot of sense. Better call quality, reliability during emergencies, comfort with a phone that works like it always has. I understand that completely, but the pricing has changed. A lot of carriers have quietly moved their landline customers onto legacy plans that cost more than newer options available today. If you have not called your provider in the last year to ask about current pricing, there is a good chance you are on an old rate. Here is what I would suggest. Call your provider and ask directly what your current plan costs and what other options exist. Some carriers now offer a basic home phone line through a digital service at a fraction of the traditional price. Others bundle it in ways that may or may not make sense for how you actually use it. There is also something called a VoIP phone, Voice over Internet. Services like Ooma or MagicJack can replace a traditional landline for a much lower monthly cost, sometimes under $5 a month after a small upfront device cost. The call quality is good, the features are similar, and you keep your existing phone number in most cases. The practical step is simple. Pull out the last 3 months of phone bills and check what you are actually paying. Then call and ask if there is a cheaper option. Most people never ask, and most providers never volunteer the information. Compare first. The savings can be real and immediate. Item number 2. Cable TV with channels you never watch. This one surprised me the first time I really broke it down. The average cable TV bill in America has climbed steadily for years. Many retirees are paying $150 a month or more for a package that includes hundreds of channels. And when you actually track which channels are being watched, it is usually somewhere between 5 and 15. That means you are paying for 180 or 200 channels you never turn on. Cable companies have been very good at bundling. They make it hard to drop channels without losing your promotional rate. And they count on the fact that most people find the process of switching or downgrading frustrating enough to just keep paying. Here is the honest truth. There are now streaming services that carry the channels most retirees actually watch. Local news, weather, sports, classic TV, and movies for a fraction of the cost. Services like Philo, Sling, or a basic YouTube TV plan offer live TV starting around $20 to $40 a month. Toss in a free or low-cost streaming service for movies and older shows, and many households can replace a full cable bill for less than half the price. Now, I am not saying everyone should cut the cord tomorrow. If you have a bundle that includes internet and phone, you need to run the numbers carefully before changing anything. Sometimes the bundle is actually cheaper than buying services separately, but sometimes it is not. And the only way to know is to actually compare. Call your cable company and ask for an itemized breakdown of what you are paying for. Then look at what you actually watch. The comparison alone is worth the 30 minutes it takes. Only stick with it if the value actually adds up. Item number 3. Gym memberships that are not being used. This one is not about shaming anyone. Staying active is important, and when you sign up for a gym, you fully intend to go. But life changes, needs change, schedules change, and a gym membership that made sense a year ago can quietly become a charge that shows up every month without delivering much. The average gym membership costs somewhere between $30 and $60 a month for a standard club. Specialty gyms and fitness studios can run higher. Over a year, that is $360 to over $700. Here is what I started noticing. Many retirees are paying for a gym membership they rarely use while sitting on a benefit they never activated. Medicare Advantage plans and many supplemental insurance plans, including some through AARP, include Silver Sneakers or a similar fitness benefit. Silver Sneakers gives you access to thousands of gyms and fitness centers around the country at no additional cost. It is already included in a lot of plans. People just never check. If your plan includes Silver Sneakers or a similar program, you may be paying for a gym membership out of pocket for absolutely no reason. Pull out your Medicare Advantage or supplemental insurance card and call the member services number on the back. Ask if your plan includes a fitness benefit. If it does, look up which gyms are covered in your area. Then cancel the gym membership you are paying for separately. Check your benefits before paying again. Item number 4. Roadside assistance add-ons. This one is one people pay for in multiple places without realizing it. Roadside assistance sounds like a smart thing to have, and it is. The problem is that a lot of retirees are paying for it 2 or even 3 times over through different services that all offer the same coverage. Here is where it hides. Your auto insurance policy may already include roadside assistance. Your credit card may include it as a cardholder benefit. Your car manufacturer may include it through a warranty or owner benefit. And on top of all of that, some people are also paying separately for AAA or a similar membership. AAA has real value for some people, especially for the discounts on hotels, restaurants, and other travel expenses. But if you are paying for AAA primarily for roadside assistance, and your car insurance and credit card already cover towing, lockouts, and jump starts, you may be overlapping on coverage you do not need to pay for twice. The annual AAA membership runs anywhere from $60 to over $100, depending on the tier and region. That adds up. I would suggest spending 20 minutes on this. Call your auto insurance company and ask if roadside assistance is included in your policy. Check the benefits guide on your main credit card for travel protection and roadside services. Then decide whether the remaining benefits of a separate membership actually justify the cost. Do not pay for the same coverage 3 times. Item number 5. Prescription drug plans that have not been reviewed. I want to be careful here because I am not giving medical or insurance advice, but I will say this as a practical consumer point. Medicare. Part D prescription drug plans can change every single year. The premium goes up. The formulary, which is the list of covered drugs, changes. And the tier your medications fall into can shift, which affects your out-of-pocket cost. The problem is that most people enroll in a plan and then never review it. They stay on the same plan year after year, even as their medications change and as cheaper plans become available that better match what they actually take. Medicare holds an open enrollment period every year from October 15th through December 7th. During that window, you can switch Part D plans. And according to consumer and healthcare organizations that help retirees navigate Medicare, a significant portion of people who do an annual plan comparison find options that would cost them less for the same medications. The tool to use is Medicare.gov. They have a plan finder feature where you enter your zip code and your current medications, and it shows you which plans cover those medications and what your estimated annual cost would be under each plan. It is free. It takes about 30 minutes. Most people skip this every year, and they overpay because of it. Check your plan during open enrollment. Every year, even a small difference in premium or copay adds up to hundreds of dollars over 12 months. Item number 6. Life insurance. That no longer fits. Again, I am not here to give financial advice, but I can point out a consumer reality that affects a lot of retirees. Many people carry life insurance policies that made complete sense in their 40s and 50s, when they had a mortgage, when they had dependents, when they had income that needed replacing. But retirement looks different. The mortgage may be paid off. The children are grown. The income replacement need may have shifted significantly. And yet the premium keeps coming out every month, sometimes several $100s, for a policy that may no longer match what the person actually needs. Some types of life insurance also have cash value that builds over time, and policyholders may not realize what they are sitting on or what their options are. This is not something you should figure out from a YouTube video. This is a conversation worth having with a licensed insurance professional, ideally a fee-only advisor who does not earn a commission on what they recommend. They can look at your specific situation and tell you whether the coverage still makes sense, whether you are overinsured, whether there is cash value to consider, or whether a lower-cost term option might be a better fit at this stage of life. The practical step here is simple. Pull out the policy documents and find out exactly what you are paying, what you're covered for, and who the beneficiaries are. Then ask whether it still fits. A lot of people have not done this in a decade. It is worth 30 minutes to find out. Item number 7. Medicare supplement plans that have not been compared. Here is the one I mentioned in the intro. Medicare supplement plans, also called Medigap, are sold by private insurance companies. They help cover the gaps that original Medicare does not pay for, like copays, coinsurance, and deductibles. And for a lot of retirees, they are an essential layer of coverage. But here is the part most people do not know. The plans themselves are standardized by the federal government. Plan G from Company A covers the exact same things as Plan G from Company B. The benefits are identical, but the premiums are not. Insurance companies can charge very different amounts for the exact same standardized coverage, and those premiums can increase every year. What that means is that someone who enrolled in a Plan G 10 years ago through one company may now be paying significantly more than someone who recently enrolled in the exact same Plan G through a different company for the same coverage. The problem is that switching Medigap plans after age 65 can be complicated depending on your state. Some states have more protections that make switching easier. Others require medical underwriting, which means the new company can ask about your health history before deciding to accept you. But in many states, and for many people, there is an opportunity to compare what you are currently paying against what other companies charge for the same plan letter. And the difference can be significant. We are talking potentially hundreds of dollars a year for identical coverage. The resource to use is your State Health Insurance Assistance Program, SHIP for short. Every state has one. They offer free, unbiased counseling to Medicare beneficiaries. They can help you compare your current plan against alternatives in your area. They do not sell anything. They just help you understand your options. Search for your state's SHIP program. It costs nothing. And for some people, the savings from this one conversation are the largest financial wins they will find all year. Check your premium. Compare what others pay for the same plan. Item number 8. Home security monitoring contracts. This one has layers. Home security systems are a reasonable thing to want, but the monthly monitoring contracts that come with them deserve a closer look. Many retirees are still paying for monitoring contracts they signed years ago. The original promotional rate has long expired. The current rate may have crept up to $40, $50, or even $60 a month, sometimes more. That is $500 to $700 a year for a monitoring service. Here's what I started noticing. The technology in home security has changed significantly. There are now systems that do not require a monthly monitoring contract at all. You own the equipment. You monitor through a smartphone app, or you pay a much lower self-monitoring fee. Systems like Ring, SimpliSafe, or Wise offer solid coverage at a fraction of what traditional monitored systems charge. Now, a traditional monitored system that calls the police and has professional oversight is not without value, especially for someone who lives alone or has a medical alert component. But the key word is value. Are you getting something meaningful from the monitoring contract, or did you sign up years ago and forget to question it? Pull out the last bill from your security company. Check what you're paying per month. Then visit their website or call them and ask what current customers with the same equipment are paying. You may find that newer customers get a lower rate, and that you can ask to be moved to it. Compare the cost against what newer self-monitored options offer. You may be paying for something that has become a much better deal elsewhere. Ask before your contract auto-renews. Item number 9. Dental insurance that does not cover much. This one is worth a conversation because dental costs in retirement can be significant, and the insurance many people carry may not be helping as much as they think. Standalone dental insurance for retirees typically costs somewhere between $20 and $50 a month in premiums. The annual maximum benefit, the most the insurance will pay in a given year, is often $1,200 to $1,500. And before that kicks in, there is usually a waiting period for major work like crowns or root canals, plus deductibles and percentages that you still pay out of pocket. When you add it up, many dental insurance plans barely break, even for people who only need routine cleanings and the occasional filling. If you have healthy teeth and go twice a year for checkups, the math can be surprisingly close between paying for insurance and just paying out of pocket, especially if your dentist offers a discount for cash or uninsured patients. On the other hand, if you anticipate needing significant dental work, the insurance may be worth it. But even then, it is worth reading the fine print on annual maximums and waiting periods. There are also dental savings plans, sometimes called dental discount plans, that are not insurance, but offer negotiated rates with participating dentists. These can be significantly cheaper in monthly cost and have no annual maximum. They work differently than insurance, so you need to understand what you are signing up for. But for some people, they are a better value. The practical step is this. Look at what you paid in dental premiums last year, then look at what you actually received in benefits. If the numbers are close or the insurance barely paid for itself, it may be worth comparing alternatives, including what your specific dentist charges for a cash or self-pay patient. Read the policy before the next renewal date. Item number 10. Bank accounts charging monthly maintenance fees. I want to end with this one because it is the most invisible charge on the list. A monthly maintenance fee on a checking or savings account sounds small, $8, $12, $15 a month, but that is $96 to $180 a year just to keep money in a bank. These fees exist because most people never look for them. They come out before you even think about what hit your balance. And if you have been at the same bank for 10, 20, or 30 years, there is a good chance your account type has changed, your fee structure has changed, or the balance requirement that waived your fee has gone up. Many traditional banks charge maintenance fees that can be waived, but only if you meet certain conditions: a minimum daily balance, a certain number of transactions, a direct deposit of a certain amount. These conditions are not always communicated clearly, and for retirees living on Social Security and savings, the thresholds may not always be met every month. Here is what I noticed when I looked at my own accounts. There are credit unions and online banks that charge no monthly maintenance fees at all, no minimum balance, no transaction requirement, just a free account. Credit unions in particular tend to have lower fees and better interest rates on savings than large traditional banks. Joining one is usually open to most people through a local membership requirement, employer connection, or community affiliation. The practical step is this. Look at your last 3 bank statements. Find the line that says maintenance fee, monthly service fee, or account fee. If it is there, call the bank and ask how to have it waived, or whether a different account type eliminates it. If the fee cannot be waived, compare what a local credit union or an online bank like Ally or Marcus would cost you to maintain a similar account. Most people have not done this in years, and the fees are just quietly leaving every single month. Check the statement, then decide whether this bank is still earning your business. So here is the pattern across all 10 of these. None of them is a scam. None of them is illegal. Every single one of these services may have been a completely reasonable purchase at some point, but circumstances change, prices go up, better options appear, and most of us keep paying without stopping to ask whether the value is still there. That is the trap. Not one big charge, a dozen small ones that nobody questions. The good news is that all of this is fixable. You do not need to make 10 phone calls today. You just need to start somewhere. Pick one item from this list that feels familiar. Pull up the bill. Look at what you are actually paying. Then ask whether it still makes sense. Most people who do this find at least one place where they are overpaying, and a lot of people find several. The money does not disappear. It just stops going where it should not have been going. That is what Better Deal Daily is about. Not panic, not outrage, just paying attention before the money slips away. If this video was useful, hit subscribe so you do not miss what we cover next. We have an upcoming video on the Medicare open enrollment mistakes that cost people money every year. and most of them are completely avoidable, and I want to hear from you. Drop a comment below and tell me one bill, subscription, or service you have recently questioned. Did you find out you were overpaying? Did you switch? Did you cancel? I read every comment, and your experience might be the thing that helps someone else. Thanks for spending time here. Take care of that money. It works too hard to go to waste.